if you assume that the US consumer is not dead, can the US consumer offset the impact of the manufacturing slowdown and make you want to keep buying US equities?
I mean, as you know, we like US stocks, so that's nailing my colors to the mast. So we are positive. And yes, consumer is a very part. US consumer being healthy is a very big part of that story. Is that we don't generally think that US economy is in crisis. So US economy is slowing but not collapsing, and you have a backdrop of very supportive central banks. So that's a very kind of supportive background.
Good morning to you, Marija. It's Manis. So you've nailed your colours to the mast. You like US stocks. The consumer is alive and well. The consumer is usually the last person to know when things are going wrong. I want to ask you about banks. I'll tell you why. We've had Citi, we've had a number of others. Take a look at this. This is the provisioning by banks. You said banks are our least favourite sector in Europe, but also in the US. And I want to get your take on this. Banks in the United States of America have the least loan loss provisions since the financial crisis. There you go. Now, that's in part to do with accounting, but it's also, I was really quite surprised. The peril of positive thinking is the title of the chart. Does this play into any of your thought processes, or why are you so anxious against the banks? Is it because of yield, or is it because of things like this?
Yeah, absolutely. Banks, I mean, it's very difficult to run a bank now. I think that's the conclusion we've seen in Europe. We are increasingly seeing in the US. When interest rates are low, when yield curve is flat, it's very difficult to make interest income. That's a really big challenge. And US banks are a lot healthier than European banks. We know that. And provisioning in US is still a lot lower than anywhere else. So that is true, because your US consumer is healthier than European consumer, definitely. But having said that, if there is very little interest margin to eke out profits, it is very difficult. And that's what we're seeing on top of that. So kind of underlying kind of boring businesses is like corporate lending, retail lending. Yes, it is going, maybe not as fast as some banks would like to have, but it is going, and it is fairly healthy. Yeah. And to me, actually, that's probably a bigger point to take out of banks' earnings season. Yes, banks are finding it difficult to make money in trading. We know volatility is very low. We know rates are very low. Yes, it is very difficult to make money in banking. But what it tells us about underlying economy is we still see consumer demand. We still see corporate demand. And that, to our mind, is more important kind of a takeaway from banks' earnings, is that underlying economic activity is still okay. I mean, I wouldn't go into like superlative and say everything is fantastic, but it is not as bad as a lot of people fear.
Yeah, boring banking is it?
Boring banking. Yeah, no, exactly.
But Marija, if the Fed manages to uninvert the yield curve, the 3-month, 10-year, and steepen the yield curve in other areas with one cut or more, would that make you more positive on banks, or would it change your view in any way if you see the Fed managing to steepen the yield curve sustainably?
I mean, that's really the point. We do believe that one thing that banks need is steeper yield curve, higher interest rate. Absolutely. Is one cut enough? I would question that, but that's really the direction of travel. I think banks need a lot higher interest rates.